Anything here that you think moves the needle in the tech playbook?
Probably not over the next couple of trading days, but again, longer term, and we've written about this quite a bit of late to our clients. We describe the box that the Fed has created as their own Hotel California. You can get into QE, but you can't get out. And I think it's going to be a very volatile year for the stock market, particularly for the tech sector. We actually welcome it. Some of our biggest holdings like Apple and Google and Facebook, they're buying back a lot of shares these days. And we would like for them to do that at lower prices. But the Fed's, in our opinion, the Fed's in a real tough spot right here.
Interesting. Obviously you see the pretty well telegraphed by now threat to tech from policy withdrawal. Interesting. There were some Fed comments this morning that the labor shortage that the Fed chair has been talking about is going to drive tech investment. How valid is that, do you think?
I haven't given a lot of thought. It seems the tech companies that dominate their space on their employment front, they seem to be managing it pretty well. That hasn't come into our calculation of either reducing earnings or even keeping any type of earnings calculation. Sorry, Carl, it hasn't been a focus of ours of late.
So, David, let me ask you this then. It's Deirdre. You know, if this is a Hotel California situation, then do you think that the Fed, are you skeptical that they're actually going to raise rates 3 to 4 times next year?
Yeah, I am. We went through somewhat of this. Well, we went through a little bit of QT back in 2018. That might be a pretty interesting playbook. And if you recall, we didn't have inflation then, and it got to the point that they were tightening enough that it cracked the credit markets. And then we had the famous Powell pivot. I think it's going to be very difficult for the Fed to raise 4 times. Not that they shouldn't, but it's going to be difficult to do that again. In our simple view, QE over the past number of years has been oxygen for the stock market, the bond market, the credit market. And to think that we're going to taper and start to maybe even sell, reduce the size of the balance sheet, and for rate hikes, if that does come to pass, we're going to have a tough year. Again, the S&P 500's doubled over the past 3 years. I mean, if back in the day, it seems like a 5 or 10% correction these days is kind of the old 15 to 20. We'd welcome a sharp pullback. We're always interested in improving the quality of businesses in our portfolio, but I think the first week or so of January is a precursor for the rest of the year.